I think it's an exciting time for the hedge fund industry because it's been a difficult few years to compete with equity markets, and in particular in the US. But we've seen very strong numbers come out of the hedge fund industry in March when markets sold off, but also year to date and over the last 2 to 3 years that we track. Just to contextualize the data we have, our clients are investors in hedge funds and other types of alternative funds, and they use our platform to gather the data from all the funds that they invest in, and we have tools for analytics and reporting. And at the moment, we're gathering the data for the annual Investors' Choice Awards. And usually we would be reporting on 2019, but this year we've extended the reporting period from January 2019 until April 2020 to really capture what's happened more recently in markets. But for all of the funds that we track, not just the Investors' Choice Awards, we're seeing funds down about 1.5% year to date until the end of May. Which compares very favorably to the S&P or the MSCI World, and those global equity indices down between 5 and 12% over that time period. But the interesting thing is that the dispersion has been enormous in hedge funds. The top quartile funds are up over 20% year to date, and certainly, over the time period that we look at for the Investors' Choice Awards, which is just over a year. And within that, most hedge fund strategies are doing well. The funds that are exposed to volatility are doing particularly well. Commodities are doing particularly well. Macro managers, it's really all over the charts in terms of performance, but on the whole, macro managers have done well through this period and made money. The only areas that are really struggling are event-driven and credit, where spreads have widened and have yet to contract to the levels that they were at the start of March.
Ryan, I'm glad you brought up the dispersion, because in the past when we've spoken about the awards, there's clearly been some outperformers beyond what you're seeing on the typical S&P 500 and performance metrics. So in previous years, we saw some oil strategies perform. We also saw some of the fund managers who are long equities then got surprised by a whole bunch of takeovers do particularly well. When you talk about 127% performance in some of the best performers, which strategies were those?
The audio is cutting out a little bit, but in terms of on the macro side, if I understood the question correctly, in terms of what strategies have performed best, it's really been differentiated trades. I think the managers that did best managed to buy volatility in certain asset classes at low levels coming into the beginning of the year or late last year, and managers that obviously in the commodity industry, there's been big moves that if in oil and gold and various other asset classes, and including in the ags, and if managers have been on the right side of that, they've done very, very well on a directional basis. But managers in the macro space that did particularly well tended to hold positions that were long volatility, and often in interest rates or foreign exchange or commodities, not necessarily in equities where volatility is typically a little bit more expensive.